I'm Donna Charpentier with Hammond Residential, and I'm here today with John O'Hara of Fairway Independent Mortgage. We are once again at Urban Exchange in South Boston, one of the many great boutiques that have recently come to the area, and we definitely recommend you check out. John, thanks once again for being here today.
Thank you.
So we're going to talk about ARMs, adjustable rate mortgages. And they've gotten a bit of a bad rap lately, the past couple of years. So before we get into whether or not that's justified, for people who may not know what an adjustable rate mortgage is, can you explain more about these programs?
Sure. Essentially, an adjustable rate mortgage is where the rate is generally fixed for a set period of time. And it can be 1 year, 3 year, 5 year, 7 year, or 10 year. And at the end of that period of time, the rate then, or the mortgage then turns into a 1 year adjustable, meaning that the rate will then adjust every year on the anniversary based on the index and the margin and the terms of the loan.
Okay. So should people be cautious, or are these in fact good programs?
They should be cautious of them because of that adjustment. However, in the right circumstance, they're a great product for the right person. And it's a matter of evaluating what your situation is going to be. How long are you planning on staying in the particular property that you're buying? If you know that it's going to be a short-term process, you're going to buy the property, you know you're not going to live there for more than 5 years, for whatever your life circumstance is, then it can be a great product because it does provide a significant amount of savings over a fixed program. So really look at your situation and have a discussion with, with your loan officer about whether this is the right fit for you, to understand what the product is, what are the risks, what happens after that period of time, what's the worst that the rate can get, and then the associated payment with it, to measure that risk of how long you think you're going to be at a property versus what your payment might ultimately end up. And in the right circumstance, I think it's a really good fit. It has gotten a bad name. And in some circumstances, it wasn't the right program for a borrower. So it's a matter of evaluating the program and then your particular situation and determining if it's worth the risk over going with a standard fixed rate mortgage.
Is it just about how long they intend to be there, or are there other factors that someone should consider?
There are other factors. A piece of it is going to be your financial picture. If you're in a situation where you know that 10 years down the road, you have a bonus or something coming along that's going to allow you to significantly pay down the loan, then an adjustable can be a good fit because then the payment will adjust based on what the balance is. Where a 30-year fix, that isn't the circumstance. So there's a lot of circumstances in which it could be a good fit that may be beyond the standard, and that's why I think it's good to always ask the question and evaluate. I also recommend not really making that decision until you find the property, because you may go into a property thinking it's short term, you find the property that's going to work for you, and you realize it's going to work for you more long term. So therefore, a fix may make more sense versus your initial feeling of an adjustable making sense.
And this is something that a lender can help a buyer with. You can look at what it will look like for fixed and what it's going to look like for ARM, and then the person can make their own decision.
Definitely, because you want to look at what's the difference in the rate and then the monthly payment of doing a fixed versus an adjustable. And over time, that differential has been greater or smaller. There's been, depending on where the market is, sometimes the differences can be a full point from an adjustable to a fixed. Sometimes it can be less. So look at the circumstance, look at your own circumstance, look at the payment, and look at kind of the worst case scenario, and then make an informed decision.